Hello, I'm Jurgen Timmer, and welcome to Timmer Time. Basically, a tariff is like a tax on an import. And on the surface, a tariff would be either inflationary to the consumer of those goods, right? Because the importer of the goods or services would add that cost, that tariff, to their price, and then the end consumer would have to pay for it. And that's definitely a concern that many people have, is that tariffs going into the US will be inflationary. But if the producer cannot pass those costs onto the consumer, then presumably it would come out of the bottom line of the company. And so that would hurt earnings. So either way, tariffs are a lose-lose situation. It either increases prices and becomes inflationary, or it decreases profits. Of course, life is never that simple. There are nuances, right? So if you're a US importer and you're importing a good out of Canada, for instance, and that import, let's say, goes up 10%, but the value of the dollar goes up 10% against the Canadian dollar, the two offset each other. And so it's a question mark as to exactly where the pros and cons end up. But trade wars and tariffs are a lose-lose situation. It's just a question of who loses more. And of course, the US tends to have less of its economy tied to exports and imports. So the exporting countries like China and Canada and Mexico presumably would get hurt more in a trade war. So tariffs would affect the markets, of course, because they could be stagflationary, right? They either increase inflation, which means that bond yields would rise, the Fed would not be able to cut rates, or they would reduce the profit margin of the companies that make up the stock market, and then you have slower earnings growth. Either way, it's a bad outcome. It's just a question of degree, right? So again, if the currency is appreciating, that could be an offset. If other alternative supply chains are readily available, right? So if a US importer can have something produced in the US relatively quickly, then maybe we don't feel it as much. But either way, there is going to be some cost to be paid for this, and so it's not a positive for the market. And you can see this in the price action, that usually on a Sunday when we hear something about a tariff, you see the futures go down, and if those tariffs are lifted or not imposed, then the market goes back up. So clearly, this is one of the events that is front and center on investors' minds right now. We're about 5 quarters into an earnings cycle, and there is no sign that earnings cycle is about to end. So the expectations for the coming quarters and even the coming 2 or 3 years remains quite robust for earnings in the US. Then the big question is, what happens on the interest rate side? So we know the Fed dropped rates by 100 basis points last year. My guess is the Fed is done because inflation has not quite come down to the Fed's target. And then we have the long end of the yield curve, long-term yields, which have been rising. And I think that is probably one of the bigger factors here for the markets going forward, that if the 10-year yield stays below 5%, I think we're okay. This bull market will continue, maybe not at the same pace that we got used to in 2023 and 24 when PE expansion really amplified the gains in earnings. So I think those days are probably behind us, but that doesn't mean that the bull market's over. I just think we're in later innings and that the pace of the advance will get slower as rates provide more pressure on valuations.